Hello guys, welcome to Wicked Big Online YouTube channel. So we are starting a Forex Mastery series, and this is first video in that series, and it is the basics of Forex. So we are going to start from the very basics, and we are going to walk you through to even advanced part where you can start the analysis for yourself and make money. Okay. So in this video, we will discuss forex and some basic things you need to put in mind when you start trading forex. So the first video we have here is introduction to forex trading. Now the foreign exchange market, the word forex, this word you see here that is named forex, right? This word is actually foreign exchange. So it's the short form for this foreign exchange market. So when you say forex trading, you are talking about foreign exchange trading, okay, which is also known as FX. So it is called FX market, it's called Forex market, and so on, right? It's the largest and most liquid financial market in the world. Now, what it means is for a market to be liquid, it means it is accessible, trades can be placed and closed within minutes and so on. So as we dive deeper, you understand better. Okay. So foreign exchange market, which is the FX market, or you call it Forex, is the largest and most liquid financial world market in the world. Over billions of dollars are being traded every day around the globe in the currency market, right? It enables the trading of currencies from countries around the globe. So you in your country, you can be trading one currency against another and vice versa, right? You allow investors to speculate on the relative values of different currencies. So let me explain this. Let's say you have Euro and USD, and what you want to do is you want to buy that currency pair. What you are doing is that if you buy Euro USD, you're actually buying the Euro and selling the US dollar, right? So if you sell Euro USD, it means you are buying the US dollar and selling off the Euro, right? So that is what it means by speculation. So you are calculating like, okay, the euro is going to gain strength more than the dollar. So for that purpose, you buy the currency. If you say no, the dollar is stronger, you sell. So it allows speculation on the relative values of what currency, different currencies. So it also allows the simultaneous buying of one currency and selling of another, which is what I just explained. So if you are buying Euro USD, it means you are buying Euro, selling USD. And if you are selling Euro USD, it means you are buying USD and selling Euro. So if you don't understand this concept, don't worry, you understand as we go on, right? Traders can take advantage of even small movements in currency pairs to generate returns. So, like I said earlier, I said in you trades can be placed and closed within minutes, right? Yes, trades can be closed. That is how liquid the market is. Okay, you cannot go to the foreign exchange market is the only market you can enter within minutes, make some good money, and you are out. The same way you can also lose all your money and you are at just minutes. Unlike our normal traditional market ways, you go to the market, before you even get to the market, you spend more than 5 minutes or so, depending on the distance. Then you enter the store, the market where you order for what you want to buy. You go to the counter, you pay, and then you come back home. You see, before you do all those things, the time has actually elapsed. But in the foreign exchange market, once you enter, within 2 minutes, you can make returns, or and likewise, you can also make loss, right? So that is how liquid the market is. Okay, so put that in your mind. All right. Okay, so let's continue. Uh, so now Forex chart. So the chart, this is what we mean by forex chart, right? Let me show you. This is a forex chart, okay? So what you are seeing here, these candlesticks, this is what we refer to as forex chart, right? So don't be confused. Forex chart. So that's what we mean by forex chart, right? Forex charts are essential tools for traders to understand price movements and identify potential trading opportunities. So the charts, when you are the technical analysis type of person, which most people are, the chart is very important to you because it gives you pattern, structures, and entry confirmation of what is happening in the real world, so you can enter buy or sell a particular pair of currencies. It also gives you historic movement of a particular currency. You can use the charts to analyze trends, market condition, and even volume. It helps you to know the point where there is support and there is resistance. Okay, you will understand this concept better as we go on, and it also helps you to be able to use certain indicators to also add to your analysis. Traders use various charts type. We have different type of chart. We have the candlestick chart. We have others apart from candlestick. We have the Japanese candlestick and the other ones. Then we have different time frame from 1 minute, 15 minutes, 5 minutes, we have 2 minutes, you have different time frames. So within 1 minute, you can place trade and close it. Okay, that we have different time frame for you to make your decision. So you can, the time frame you stick to depends, the type of trader you are will determine by the time frame you stick to, right? So if you are the type that scalp, you don't want to stay long for in the market, then you should be looking at within 1 minute to 5 minutes to make your entries and exits. Okay, so that is forex chart. Are essential tools that help us to predict market movement and identify trading opportunities. All right. So forex in itself, what does it mean? Like I said earlier, forex is what stands for foreign exchange, and it's a global currency exchange. So to explain this statement better, global currency exchange, right? This is what I want you to put in mind. Let's say you have US dollar, but the person you are trading with, all the particular thing you want to do requires that you use Japanese yen. So now what you need is Japanese yen, but what you have is US dollar. So you go to the Forex market, which is a foreign exchange market, right? It can be in the bank, it can be over the counter and anywhere. So what you do is you give them your dollar. They will give you the equivalent of that dollar in Japanese yen. That is over the counter trade. So the same thing we are doing in this forex market. You are buying one currency and selling off the other. So in the case of the Japanese yen and the US dollar, in the forex market, you see it as USD JPY, which is US dollar against Japanese yen. So for this scenario I just gave you, where I am selling off, I'm giving out my US dollar and buying Japanese yen, it means that I'm actually selling US dollar and buying Japanese yen, right? So that is what Forex is a global currency exchange. It's just currency that is being exchanged, nothing else. They are not selling food, they are not selling cars, they are not selling anything. There is currency that is being exchanged. It's a market over the counter, right? Decentralized and accessible 24 hours a day, 5 days of the week. So you can wake up anytime and decide to trade. Although there are better trading time, but the market is open for you 24 hours from Monday to Friday. All right, so the market is highly liquid. High liquidity is found in the forex market, which may allows you as the trader to enter and exit positions with low transaction cost. Okay, so you can just deposit $10 into your account, you place your trade, and the trade moves $1 profit, and you close it immediately. So that is high liquid. the market is compared to other investments where you have to wait for a period of time for you to get your return. The forex market, you can get return within minutes. All right. So what are the key market participants? The market, if currency is what is being exchanged, then there are institutions that actually exchange these currencies. One of them is banks. Of course, the primary people that control currency exchange in the world, all around the world, is the banks, right? We have banks, which are the largest players of what? The foreign exchange market. You see them, they conduct interbank trading and provide liquidity. So we also have the retail traders, which is you and I. We trade from our homes. We just fund our account. We trade with brokers, right? So the brokers work directly with these banks. The bank provide liquidity to the brokers. The brokers work with them while we work with the brokers. So the broker is like a middleman between us and the bank. When you place your trade, the brokers help you to place that trade in the foreign exchange market. So the outcome of your trade, whether positive or negative, will be revealed to you as well, right? And all this happen within minutes. So we have the retail traders, individual traders who speculate on currency price movement, right? Then we have institutional investors, large entities like the hedge funds, the mutual funds, and the corporations. These are companies that will participate in foreign exchange market. Now, there are fundamental factors that affect forex prices. Remember, I told you it's all about currency exchange, and one of the factors that affects it is what? Interest rate. Interest rate will always affect currency, right? So let's say the Euro USD, if there is if there is inflation in one of the currency pair, it's going to tell on that currency, right? If there is high interest rates, it's also going to affect the currency. So by affecting the currency, it favors the order that is paired to it, right? So changes in interest rates impact currency value and investment flows. If interest rate, let's say I invest my money in the bank and I'm getting 10% per annum. If that interest is reduced to 5%, chances are everyone wants to pull off their money and put it in a better place, which will negatively affect that pair, that particular currency, right? Because now investors look at that interest rate as though too small. Likewise, if interest on loans given to small businesses are hiked up, it's also going to affect, because nobody is going to take loan where they will be paying massive interest rate, which will also affect that particular currency. So interest rate also affects currency pair, and when it affects it, it will affect it in the currency or in the forex market. Then number two is inflation. Inflation can devalue a currency, and when a currency devalue, it leads to depreciation. It will weaken that currency over the other one. So let's assume USD JPY, or let's say Euro USD, which is beginner friendly trade. Euro USD has the Euro USD. Let's say the euro now have high inflation. The inflation will make the currency to lose value. And when the currency loses its value, it will lead to depreciation, right? Now, while the euro is depreciating, the USD will be appreciating on the other hand, which will lead to Euro USD, the chart. You now see that the chart will start dropping. Why? Because the USD is now stronger than the euro because of what? Inflation. Then number three is what? Economic growth. So when a country's economy is growing, it strengthens their currency, which will impact the value of that currency in the forex market. Okay, so forex trading strategies for beginners. So these are just theory. you feel free to subscribe to this channel if you like contents like this. And don't forget, this is just the very first video in the Forex Mastery class, where we'll teach you everything A to Z. No subscription required. We learn everything that you ought to learn, and nobody is going to ask you for any money. So subscribe, like the video, share with your friends, share with your family, right? So everything you see us teaching here, we are going to do the practical of them in our next video. So do well to subscribe and put on your notification bell to receive notification once we drop that video. So the strategies for beginner, one is trend following, which is the most advisable way of trading. You don't want to be on the opposite side of the trend, because you are going to be wounded most of the time. Okay, so you identify the trend. So what we mean by identifying a trend is this, right? This market, is it going upward or is it coming downward? Like if you observe from this point down to this point, we can refer to this one as a downtrending market, right? So from here down to here, and so okay, this market was trending downward, is it right? So this is what we mean by identify the trend. So when you identify the trend as a downtrending market, the next thing you want to do is you want to look for entry opportunity to sell, because the market is selling. But if this is a 15 minutes chart, but if you check the overall trend and you find out that the market is buying, all you want to do is to look for buying opportunity, no matter what the smaller time frame is telling you. Look for a buying opportunity, unless, which will bring us to the next one, unless you are a scalper. Now, scalping is taking small frequent profits by exploiting minor price changes. Scalpers use 5 minutes and 1 minute time frame for their trade, and what they do is a scalper can take trade from here to here and exit the market, then take from here to here, exit the market, take from here to here, exit. So what they are doing is they are just following the minor movement. They are not actually interested in long term. They are just following the minor movement. So when the market moves a bit, they take that little profit and they wait. Market gives another opportunity, enter again, take a small profit and they wait. So that is for what? Scalping. Then we have news-based trading. This one is when you wait for news events and you react quickly to economic data releases. So news events are actually good trading. Like if you look at this long spike upward, this was caused by a news event, right? So if you are a news trader and you are able to predict or analyze this very well, and you just place your trade, so within few minutes this one you would have made this profit and you are out of the market. So that is what news trading is. They wait for what? The economic data releases and market events, then they react quickly to it, because news actually react very fast. Then we have range traders, right? The range traders are those that follow the market up. The market is going up, they follow. The market is coming down, they follow. It's going up again, they follow. So let's take the chart backwards. A good example would be, you see from here, the market was actually ranging, no particular uh, trend here. So the market was in a range. So range traders will follow the market from here down, and when they sense that the market is about to turn, they close it and they follow it upward. They sense it again, they close it, follow it down. So that is range trading, just like the name, range, up down, right? That is range trading. Then we also have the position holders, the day traders and all that, but this should be enough for you for now. Okay, all right. So now let's look at some of the risk considerations in forex trading. We have leverage, right? Leverage helps you, but it can also destroy your account. So what is a leverage? Let's say uh, your forex broker, the broker you have chosen, is giving you a leverage of 1:500, right? What it means is that any money you deposit into that account, they are going to multiply it behind by 500. Although you are not seeing it, but what you actually have in your account is not $10, but $5,000, because you multiply that 10 by 5, right? It becomes $5,000. So now that $5,000 will enable you to place a standard trade in the foreign exchange market. What this means is that you can make massive profit by leveraging on leverage. Likewise, you can also what? Make massive loss. So leverage helps to magnify your account size, right? So you put a $50 for a broker that offers a leverage of 1 is to 1,000. They are going to multiply that amount you deposited by that 1,000, so that anytime you place trade in the foreign market, you are going actually placing trade be above what you actually have in your account. Okay, so there are even brokers that offer one to unlimited. Unlimited means you can place so many number of trades, because leverage limits the number of trades you can place, right? So there are brokers that their leverage will not allow you. If you have a $10 account, you cannot place more than one trade, and you cannot even trade on gold with that amount. Why? Because the leverage is small. They limit their leverage to protect your capital. But there are brokers that give you unlimited leverage. Why that is very good, it's also destructive to your account. Why? Because if your analysis should go wrong, without unlimited leverage and you have $10 account, you can place even 100 trades in that $10 account. So you can use it to quickly grow your money. However, if that trade should turn against you, then your account is gone. So we have leverage, right? So these are some of the risks you should consider. Some things to consider in the foreign market. The leverage you are choosing can magnify your profit, it can also magnify your loss. Then volatility. You should know that trading CFDs, they are volatile markets. Currency can be experience rapid, they can experience rapid price swings, right? So imagine, for instance, somebody that is not aware of this news event coming up, and you are looking at the market and you say, okay, let me just sell from here down to this place. For in the case of the scalpers, so let me just sell down to this place and exit the market. The moment you enter expecting that the market will go down, there was a massive, if it happened within a twinkle of an eye, this massive surge upward will just come up. So you should consider that the market is very volatile. It can experience rapid swings immediately, can go against you or go for you within split seconds. Then you should also consider your emotions. In trading, it is always advisable that you put your emotions into check. You have to discipline yourself and apply proper risk management, because when you don't apply proper risk management, you'll be afraid of the trade. You apply risk management, you calculate how much you are willing to lose, then before you can enter any what, any trade. Then the last one we have here is regulation. You want to trade with a broker that is regulated so that you won't be scammed, right? Yes. So you trade with a broker that is regulated. So these are some of the things you should consider before opening an account with any broker. The first one is the leverage they are giving to you. You should know that the market is volatile, and you should put your emotions into check and trade with a regulated broker. Okay. So now, technical analysis. In trading, we have fundamental analysis, which is speculation. You are using the events. Let's say a particular country have a natural disaster. By having a natural disaster, say earthquake, it means that there will be pause in many of the economic activities of that country to tackle that natural disaster, which will impact negatively on their currency, meaning their currency will start losing value in the foreign exchange market. Now, this kind of traders, what such traders do is that because of this country is experiencing, their currency will drop. So they will go and sell off that currency. You see it now, they will just sell it off. Now, and they will make money from it as the currency is dropping. Such people are called fundamental traders. They they rely on the happenings around the world to decide what will happen in the trade, right? On the other hand, we have the technical analysis traders. Technical traders. These are people that analyze the chart. They look at the chart, they understand the terms like support and resistance, they do different in market structure, they map out and predict the direction that the market is likely to go next. They are called what? Technical analysis traders. Okay, so technique is the popular approach used by forex traders to predict future price movements based on historic data and market what statistics. So you study the chart patterns, you sometimes we use indicators, oscillators. Traders use all these things to what? Identify trends, support and resistance levels, and potential entry and exit points, right? So that is what technical analysis do. They look at the chart, based on the previous happenings, they can tell you, okay, this market is likely to behave like this because of this structure it has given to us, and so on and so forth, right? All right, so that is some of the things you should consider. That's what we mean by technical analysis. So lastly, we have risk management, right? Risk management is very crucial in when you are trading and you don't have risk management plan, then you are going to run into serious loss. So risk management helps you to know that okay, I'm not risking more than, let's say you have a $10,000 account, and your risk management tells you that okay, in a single day I will not risk more than $100. So I will risk 100 to make 200 or 300 per day. Now, as a disciplined trader who is applying risk management, the moment your trade goes against you and your $100 limit of that day is hit, what you do is that you leave the chart, you don't trade, you don't chase the market, you avoid it. Why? Because you have what? Analyze your risk, you have your stop loss in place and everything. You are using proper loss size. Not that you have $100 account, you are using one lot to place trade on gold. That is poor risk management because a slight move opposite to your prediction, your account is gone. Okay, so you use proper risk lot sizing, you use stop loss orders, and what you diversify your portfolio. These are some of the things we will also teach in this channel as we proceed. Okay, so do well to subscribe so you don't miss any of our videos. Okay, so risk management is also what is crucial. You want to ask yourself, okay, for every $10 I risk, how much am I going to make? If my risk management is that I risk 10 to make 30, it therefore means that if I make 30 in a day, I should be okay. The day that the trade didn't go for me to make the 30 and it actually went against me, I hit my $10 target of that risk of that day, I stopped trading. So these are some of the ways you put risk management. And based on my account size, what size of lot should I use? What lot size should I use? And all that, okay? So finally for this video, we have money management. Now, in addition to your risk management, you want to manage your money, right? Money management is vital for forex traders so that they can control risk and optimize profit. We use strategies like setting realistic profit targets. Now, imagine you have $100 account and you are telling yourself that today I'm going to make $1,000. Now, what you are going to do in order to meet up that target you have given to yourself is that you are going to leverage the entire account, which can go both ways. It's either it will actually work for you or it will go against you. So when you just want to risk the money, you are free to do so. But if you are applying money management, you can't do such, right? Just like your risk management, you must set realistic targets. Okay, I want to make 10% per month for my account. I want to make 5% per week. Make sure the target you are setting for yourself is realistic, not something that will make you to over leverage your account. Then you use a proper loss size and you practice, you discipline yourself, and you to take trade that only follow your trading plan and rules, because every trader must have plan and rules. So you take trades that follow only your plans and rules. If it does not follow your plan and rule, you avoid it. These are some of the, so you must also discipline yourself in order not to lose money. So applying sound money management principle can enhance overall trading performance and help achieve long-term success in the forex market. You want to treat the forex market like your business, your day-to-day business, not just like somewhere you go to gamble. No, you need it for a long term. The market can serve you in your entire lifetime if you can develop profitable plan and patience, discipline enough to what to run with it in the long term. So that's where we'll be ending this video. If you find this video helpful and informative, leave a like, subscribe, turn on your notification, and so that you be notified about our next video. I will see you in the next video. Bye for now.